Welcome, it's the Market Sniper. How are you doing? Okay, so we've had the reason gold sells off is there's a trade deal with China. Yep, they reduced the tariffs on China by 115% down to 10% like the rest of the world in exchange for China reducing its own retaliatory tariffs, which they wouldn't have put on if you hadn't started that in the first place. And we declare victory and an amazing deal. Also important, the US agrees to move forward in the spiritual of mutual respect. None of this barnstorming drunken men in a pub swinging and brawling. That has had mutually beneficial economic trade relationship, which is almost a word for word what China had been stressing since the very beginning of the whole tariff tantrum, which was entirely one brought by Trump. So it's a triple T. The Trump's tariff tantrum, entirely homemade, and of course it brought into focus the US debt markets, which is a very, very interesting thing. And we've had some interesting commentary with China at 1.6%. Apparently certain people go, China's in a depression. Very interesting. But why is the US at 4.2? If they're not in a depression? My personal opinion is that the whole economic environment is very depressed and could well be rated as a depression in due course, and that recessions are being denied and denied and denied. Why? Debt market 2020 call, refer, going to keep reminding you of that one, September 2020 on the debt market call for it to the downside, which is a debt-based collapse, meaning the Federal Reserve can't actually do anything near as much as people think they can do. Everyone goes, printer goes, brrr. Why? Why is the global debt market situation so bad? Well, there's well over 330 plus trillion in global debt. And here's something you'd like to know. 1 year and 2 year yields on Swiss debt. So Switzerland is probably the least bad of all the fiat and debt-based nations in terms of where they stand. And 1 year and 2 year has reverted negative. That means, for example, if you were, do this with me, if you were to buy a 2 year yield, you're actually going to get less money back at the end of the 2 years than if you just threw the Swiss franc under your mattress. So let's just be clear. The value of this is it highlights the value of cash and, God forbid, gold. Gold that's sold down on a tariff deal. Really? And you think that's going to be the end of the whole story? No, my friends. Negative yields on a semi-serious nation like the Swiss National Bank and the Swiss debt markets and the Swiss currency, the franc. You're likely to see the franc appreciate. You're going to see more Europeans moving their money into Swiss bank accounts, and they're going to accept less money back than they got. So a negative yield means you get nibbled. Now, the amazing thing with that gold bar under your bed is it doesn't get nibbled. It weighs still a kilogram a year later, 10 years later, 30 years later. It still weighs what it always weighed. It doesn't rust. It doesn't ask for rent. It doesn't do anything. You don't need to feed it. It just stays exactly as it should be. And even cash, until they call an expiry date on cash, which, by the way, whilst we transition, we need to make a small point on cash. You see how cash becomes the enemy? If a bond is going to lose you money, instead of putting 100 grand in a 2 year Swiss bond instrument and actually get 99,000 something back after the 2 years, never mind that Switzerland has its own inflation rate and it's not negative. It costs more every year to live. We'll ask Grok, shall we? We'll ask Grok what the Swiss inflation rate is. Remember, the stats will lie. The government lies. But in the meantime, cash. If you bought the Swiss francs instead and tried to get put them under your bed, because you don't believe in gold, you do hate the idea the value will go up, but you at least want the same amount of money back, and you'll take the hit on inflation over 2 years on that money. Here's what you're going to run into in the likes of Spain and probably other European nations like it. If you wish to withdraw more than 3,000 euros in cash, you must notify the tax agency at least 24 hours in advance of the withdrawal. You must also specify the purpose of the withdrawal. Failure to comply with this requirement may result in fines of up to 150,000. We're going to fine you 150 grand for not telling us what you want to use your own money for. Your money in their bank. Now, let me tell you, the minute you start having to talk to agencies and explain what you're doing, it isn't your money. It's their money that they're allowing you to have access to only if, but, when, and on the following criteria, plus an investigation up your rectum. What are you doing? How long have you been doing it for? What is it? All of this. Interrogation for wanting cash. And that's why. Because negative interest rates is what they're currently doing, supposedly on the safest debt. And one of the ways to circumvent that is actually holding the cash. The only thing you'll lose is the inflation rate you will experience. What would the inflation rate? 2 years inflation. 2 years inflation. Buying power destroyed. In Switzerland, how much will 100,000 Swiss franc be worth 2 years later in buying power terms? Let's see what Grok will tell us, bearing in mind it's a captured, elongated muskiness tool, and the stats it will draw on is the liar stats that the statist will give you. Nonetheless, let's have a go. The average annual inflation rate in Switzerland is 2.1%. The average annual inflation rate in 23, in 24 is 1.1%. So, doing the mathematics, fancy mathematics, you will get the buying power returned to you of 97,254. Oh, hold on. I'm not even sure that's correct. Are you finished? Final answer. They did the 1 year and they had to do the second year. 99, wait for it. With an estimate of 1.3% in 2025, it will be worth 97,450 Swiss francs. In buying power in 2027, if you were to do that today, it'll have 96 to 99,000. There you go. You give them 100 grand. They give you 96 back later for using your capital and the privilege. And it costs you 4,000 Swiss francs to not have your money. So you see how cash becomes a problem right there. And you see how if you'd wanted 100,000 Swiss francs and you popped over to the bank, how they're going to have questions for you. And you should submit a document saying, you jammy thieving scoundrels intend to steal from me and the short-term debt instruments are negative. As a result of your proliferation policies, your scoundrel synchronized economic leper, global leper colony, we have decided to protect the buying power of our money, and we want the cash under our mattress for any extraneous false flag or other events that you intend to pull upon us during this period. And for that, we'd require a certain amount of cash. And for the remainder, we'll take gold. Thank you very much. And thank you for being a criminal and forcing us to have to take these actions and then having the cheek to dare to require me to explain why and what I am doing on any meaningful scale for the fruits of my labor for my entire life from protecting myself from criminals like you. That's the whole story in a nutshell, friends. The Swiss National Bank, 1 year and 2 years gone negative. Why does that happen? Let's cover a little bit more about that in between the buzzers and the beeps. The reason that happens is debt markets are afraid of default. Right now, the American U.S 10-year, that's our gold chart. We'll come back to Goldilocks in a minute, which sold off on a Chinese deal. We did warn inside the community, by the way, book a call, that is inherently a flag and it was a walkout of spinning tops and you should not be a buyer at these levels. We expect a dip to the lower side, and a dip indeed you did get, and now you are dipping further. The question is, will you run that low? Will we go from that being a falling wedge into a larger falling wedge? Maybe. We will see, time will tell. But in the meantime, we're talking about debt markets. So let's go instead and go past platinum markets and go point to, also platinum sold off, cause deal, China deal. There you go. There's a reason. So let's have a look at the U.S. 10-year. So certain America maximalists that you'll know that are big buds of mine are putting forward that China's in a depression because their rates are at 1.6%. And America's clearly not in a depression because it's at 4.4 and climbing. And it's climbing even in an environment where the dollar has weakened. What's actually happening is the main default risk is staring you right here in the face. It's the United States of America. By the way, you open there from a close there. That's called a gap. That's called a gap. That's your super liquid bond market. That's called a gap. And the rates are going up. Let's have a look at what the Dixie is doing in the meantime. We'll take that chart away and we'll go to this one. We'll look at it against the euro, which is probably the most normal substitute. And here you can see the dollar is gaining a little bit of strength. Boom, 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 bosh. At least this time, the dollar's getting stronger. That means the Dixie could be in a state of reversal. It's not the broken seesaw moment we told you would come, which did in fact come, but it is clearly a sign that interest rates are going potentially higher in America. Something we've said and repeated. You are not going to get cuts to the level that people expect. You're going to get higher highs and higher lows as a result of a debt-based crash. And the funding and rollover of all the debt is going to be exceedingly expensive. Look at that move up from the Dixie from below 100. The dollar is getting stronger and the rates are getting higher on the 10-year. Now, if we have a look at the 30-year, which is even longer term, we're having a runaway. So there's two things that are happening. The longer term is right up at 4.863. That's why the 10-year almost has to catch up a little bit. This is very high. You're very close to 5%. By the way, the last spike actually took you beyond the last spike on the 30-year. In short, you're getting a steepening curve. The further out you go on duration, the higher the interest rate is needing to be, and it's got very steep. It's real tough to refinance for a long term if you're America. So everything is clustering up on the short end, and now the 10-year is catching up to what the 30-year has done. So by being on the high side, you're very close to highs on the 4.86 here on the 30-year. Let's go on the way down back to 10. We'll go via the 20-year and you'll see something very, very similar. That was equivalent to the high, very equivalent, slightly below, and the 10-year is now running. The 10-year is now running in a disorderly fashion to the upside. You'll note that didn't make a new high at the time, but now you are showing much more upside. So the mid-long 10 years are starting to lose more value too, much like the 30 years did. And how do they do that? The rate goes disproportionately up there. So we owe it to ourselves to ask, what does a 2-year in the environment of the Swiss example, what is it doing? Well, you see, they've been putting a whole bunch of debt out on smaller duration. Why? Because the interest is lower and they can't afford to pay their existing interest rates. So everything that gets rolled has to go in the cheapest available. And because the curve is steepening, they can't do 30 anymore. It's right up to by 5%. The 10-year is now moving higher and catching up. So everything, now that Yellen started that cycle of bringing all the debt forward on shorter duration, means you keep pushing the debt out and rolling it into a shorter duration, which means it's about to come back a lot quicker. Plus, you're going to be borrowing at the same absolute parabola rate. America is in a debt-based collapse, as we told you in September 2020. And that is why bond money that has to stay in debt instruments is running to Switzerland and is prepared to have a guaranteed loss to the Swiss inflation rate. Guaranteed loss. and is hoping that the Swiss franc's relative appreciation, we have a Swiss franc trade set up in our community. Go and click on the link below to book a call to find out which pair, and it's not the dollar, that we are trading it against. That is what's happening. Your short-term rates are going up too now. That means the debt, having steepened the curve, the value is at the low end, the short duration. All the debt is being lumped on there, and everybody sees that. They stop wanting to buy. They want to demand a higher yield. You're now starting to get collapse even on the short end. So you are breaking back above 4%, even more than the 10-year. The short end is getting expensive too. So not only first you have a steepening of the curve, and then the short end starts steepening too. Rates across the board, as we warned, cannot go lower. You're going to go higher highs and higher lows. This has been our message ever since. Here's the 1%. You started at 4.06. You're right up at 4.1. That's a big candle right here today. It's a big candle. The short end of American debt is now moving. The whole funding mechanism is now going to start rising up. Instead of just a steepening, you're going to have the whole funding mechanism climb. Now, if you understand what that means, you'll understand why there is so much debt wanting to get into Swiss debt. But as we've already explained, guaranteed loss of money and buying power loss of money to inflation. We calculated roughly 96,000 Swiss franc back in 2 years on general, using their liar inflation statistics. But at least you probably will get your money back, because they're good for it, not like America. So that's where you get. Now, when people say, as our favorite America maximalist does say, that China is in a depression because its rates are so low. You know, ours are normal. Yours are normal because everything is in a recession and they should be low, but you have such a high risk of default. You have such a high risk. One more time, we want China, not Switzerland. You're at such a risk of default that your premium for possible and potential default is climbing. And let me say, 4% just doesn't cover the fact that America is going bust. I wouldn't take a bond at 20% out of that. But you need 5 years where they don't crook and cheat on you and fail just to get your money back. At 20%, it doesn't reflect the true risks. They've covered and they've protected the junk bonds in terms of high yield. This is a debt-based collapse, guys. A trade deal with China changes absolutely nothing for that. And that gold dip is 100% an opportunity for you to buy an asset that in a year's time, I'm pretty confident will be higher than today by some substantial degree. And by the 2-year end and expiry of that Swiss bond, that's going to take the better part of 4,000 Swiss franc off you per 100,000. That's roughly 4% on their liar number, where you should probably be getting 10% at least in terms of true inflation. Your gold will be higher and it won't have taken anything away from you. It does not die. The great criticism of gold by the great Warren Buffett was Buffett, Captain America, who's choosing to stand down right now at this very moment. He's choosing to stand down right now at this very moment and hand over to someone with vague mentions about the currency and a more internationalized exposure. This is your big signal, my friend. He doesn't want to be the 90-year-old going to a 100-year-old running this show who's changed complete tune. And he probably doesn't want the attention that governments will give him suddenly if he starts talking down about America. What a time to retire. What a time indeed. 1.66 China in depression. If China, who makes 71% of everything that gets sold, is a depression, according to Mr. America maximalists, then you can rest assured that America is too. 71% of Amazon goods are sourced there, 80% of Walmart goods. They brought that down to 60, but a lot of that's been masked in proxies like Vietnam and others that still have Chinese production behind it. So there's no point in talking in singular nations in a globalized world. Despite this bifurcation talk, despite all of that, the deglobalization trend, the workshop of the world is China. They produce more than they consume, and they stack gold with the surplus. America is the consumer of the world. They consume more than they produce, and they stack and try get people to buy debt instruments for the shortfall. They've had record trade surpluses. The key nation that is going bust and is leading the bust is America. Their interest rates are higher than other nations because there is now a risk premium attached. You are looking at this trade deal being secured, and actually it guarantees further future record trade deficits and record surpluses for China, which will put even more pressure on the debt markets and everything that is going on in America. So where does that leave you with gold? Back to gold. Whether this runs this level or not, in the longer term, gold will likely be an amazing purchase. I am going to be watching for potentially this, future-scaping this. By the way, a reminder, we will be in Frankfurt, Germany in the not too distant future, coming around about the 16th, 17th for the Seoul Financial chat that we'll be giving in Frankfurt, and we are available to chat to people that are interested that are attending that conference. We'll be meeting some community members and some other presenters at the show. So if you are German and you're a follower of the channel, please feel free to get in touch. We love to engage, and you can email support@themarketsniper. So this could be the next one. You might make a marginally lower low to the downside. Maybe the pullback is larger for a short while. Until the truth comes, I would utilize at an investment, not a trading, at an investment level, every opportunity that is afforded me to ensure that I accumulate investment gold whilst this discount window is being afforded. Because the future record trade deficits of America are coming. The higher interest rates on American debt are coming. Yes, you may get a dollar spike out of that. You're seeing it turn at the moment, eventually. And that will be an unhealthy schizophrenic stage that will be needed to be dealt with in and as part of a collapse of the American debt-based system. This is going to bring contagion on all forms of debt. We're seeing, let's talk about Bank of Japan, that proxy and ally of America. I almost forgot to do that one. And you will see that actually Japanese rates that have started to climb quite immensely. You should be wondering what this will do to the carry trade kings. Boy, oh boy, 3 years ago, we had a target of 1.603 on Japanese debt. Everyone thought we were bonkers. Oh dear, we forgot to talk about this one. We're allowed to brag a little bit every now and then. We do it humbly. We're often wrong, but we've got to talk about this. Go and look on this channel earlier. I started 2-3 years ago saying you're going to get a 0.5. Then we got this structure and we called for a 1.603. You almost made it there. You had the carry trade unwind that was, I think over here. Maybe I'm wrong. It was more over here. Actually, it didn't affect this. This is more recent. That's March. You had the rates pull back. We are still awaiting a 1.603 on the 10-year. I forgot about this draw. It's lucky I went to this chat. We are awaiting this target to be run on the Japanese debt. And as we have asserted, this is a re-rating for most nations' debt, except Switzerland's short end. Please note, short end. It's not the 30-year Swiss that's going negative. It's the short end, because you get your money back quickly and you can put it out somewhere else again. You don't get locked in on a long-term. Of course, you can sell a long-term debt instrument to someone else, but there may not be that demand. So at the moment, you are seeing a key increase in rates across the board, including Japan. And we called this reversal. We've got all the targets in here. And if I go back to log scale and pull this out, you will actually see that we have insane targets that point to the likely event of debt-based collapse. In other words, there are technically unsurpassable targets that would, if they were needed to be made, probably would, there's no way of getting there. They're going to collapse. This is a reversal. This is the M-shaped reversal that we saw over here. down there. You then got back up there. So the neckline roundabout there. You saw the first upside HVF there. You got a brand new mega HVF here. And we are not far from those targets being made. You are watching a debt-based collapse. All interest rates are going up on the long end, 10-year and above on most nations. I haven't checked the Swiss. It's probably the only one that might be stable. You're seeing even German, all of them. This is a debt category is toxic. We have said, and we've had the lovely Mark Farber on, an incredible guest. And he was occasionally wanting to trade and even have short-term holdings of debt. And we're like, Mark, never touch debt. And apart from shorting it, there is no good debt instrument to hold, even though you will be told that the Swiss franc is giving you a negative yield. It's still not, it's even worse for that fact instrument to hold. Let's have a look at the Swissy on the 10-year. This is a debt drill down and the effects of it on gold. You will note that whilst the short end has gone negative on Swiss, so people who want to park money up for just a bit are prepared to buy Swiss. The 10-year is sitting at 0.3 and it's had a couple of schizos. It is not trading down. It has not yet gone through the zero. Let's take it up to the higher time frames. The 20-year has not gone up. It's at 0.49, which is roughly 0.5%. Bear in mind, this is considered the most safe nation for debt, and the 30 years at 0.44. So actually the long end of Switzerland debt is not going up significantly at rates levels right now, even though it's traded up a tiny bit on all of them just for today. You wouldn't say it's mooning. So on all major nations outside of Switzerland, let's just check Germany. How is the real long-term rate on Germany? Up, up, up. Remember, we said to you, upside HVFs on the long term. You're going higher. You will see rates you never thought in these other nations. We drew it for you over here like that. We did it on this very channel. We did it for Britain. We did it for France. We did it for Netherlands. We did it for Germany. And we showed you that all the Northern European nations, which are supposed to be more prudent than the southern nations, are all going to be devaluing in their long-term debt. Let's see how the 10-year is for. The 10-year is doing for the Germans. Remember, they've got to suddenly start militarizing, cause war with Russia. There you go. It's turning up as well. We warned this would happen. We said there was your break. From after we said that, you actually had a pullback all the way. Why? Because dollar was collapsing. So the Eurozone could be more dovish on their rates because the currency was almost too strong against the dollar. Now we're starting to see the dollar reversing on the Dixie. And what are you seeing? The rates are reverting to the upside, and they've yet to start their big military spend. They're going to be bringing issuance, new issuance. There is a debt-based collapse. How many times do we say it? And the whole world is in this together. You don't have China in a depression and everything's just fine in the US because they've got normal rates. It's a price risk on the expectation of failure or some form of default. So let's go GB on the 10-year. You can see the United Kingdom is reversing back up. We've called for this to be higher for longer. Again, squeezy, squeezy, Japanesey, and a wind-up squeeze, all coming along the road. Where do you think this ends? Higher rates, Britain. Higher rates, Britain. Buying a house in the United Kingdom right now, you better fix your rate, and your price property is going to go down in value unless they get to devalue that currency really, really fast as well, so that it masks the fact that you are buying an asset that is actually losing value. Better to buy small and get some gold, in my opinion, or not to buy at all. But sometimes you just need a home, and that's where you're in. Rates are going to go up, up, up. It's going to affect the ability of people to borrow, and it's going to get more expensive. A nation like the Dutch, which actually has a pretty decent export model to the US. Let's go put Netherlands in there. NL, I think it is, or is it NE? I can't remember. NE must be L. Netherlands 10-year same structure across the board. I literally barely have to move the chart. This is going higher. This is going higher. And we've said already that you will be into the fours on Dutch interest. So what does this all mean? You're in an environment where the valuation of bonds virtually throughout the world are going down in value. Apart from the ridiculous situation of Switzerland, generally as an exclusion, there may be one or two other nations as well, maybe Singapore, I don't know. We don't have to look into that. I'm talking Europe and the Western nations. Rates will be going higher. Some people who follow our channel are from the land down under, and some are from Canada. Are you from Canada? Are you a Canadian from Canada? You must be. This is a beautiful upside HVF. Aussie, 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 you are going to get spanked, my dear boy. You're about to get spanked. In fact, I've got to do the draw on this one. We have a lot of Australians in the house. You're thinking of buying property. Terrible idea. Buy gold. Buy Aussie gold. Go to your mint. Go to the Perth Mint. Go and grab as much as you can get away with grabbing, subject to all the questions. 3,000 euros. What are you doing? Have you filed your intentions with the tax authority? Oh dear, it's not your money. It's never been. And the illusion is almost over. Let's have a look at that low. Aussies, this is the time to be selling property and getting out and putting it to gold. And you could probably rent for less. That is where a pretty conservative draw sees you going to, wait for it, towards 6%. Australia, do you see me? Look into the eyes. Your 10-year, one of your benchmarks, looks like potentially 6%. And I would actually say that pullback is far too deep. This is a prediction that we utilize, a prediction element to the tool. I'm actually going to adjust it slightly. I think it goes closer to the 6% all by its very own self. I'm going to put it like that. Couple of change a few variables. That's more like what I would expect. That will take you through 6%. Australia, hear me now. Where's our New Zealanders? Let's do everybody. It's just that kind of show. It's just that kind of show. It's the great debt show for you all. New Zealanders, how many Kiwis out there? Hit the like button right now. We never forgot you. Listen to that. Listen to that. Oh my goodness. What have we got here? The Kiwi 10-year. Also a potential likely upside continuation. A little bit less bad than Australia, I'm going to say. A little bit less bad. This would be a bit of a speculative draw right here. So I would say that's not reflective. I'm going to take it off. But you would say longer term up, but a little bit less bad than your Australian buds. Don't forget, a lot of the banks that are involved in Australia are also involved in New Zealand. So we know about that. What about the Canada? The country of Canada, how do you do? Let's see, is it CA? That's right, CA. Canada. Well, Canada, the least extreme, maybe along with New Zealand. However, I'm going to say you certainly are going to break up. You just don't have an HVF. You have a falling wedge. You have a 3 impulse falling wedge. That is going to break. In fact, it's still terrible. You're actually at the low end of your rates. Apart from the 2.8 moment, we are calling 1 impulse, 2 impulse, falling wedge, 3 times a lady. I'd say the Europeans are probably worse than you generally, but you're going to get a major upside move too. You're going to break out of a 3 impulse falling wedge to the upside. And that was supposed to be a top. Remember that? Remember that? That was supposed to be a top. No, it wasn't. It went quiet and it went up. Too much debt, rallied up, and now you're in a 3 impulse falling wedge. You're actually at the low end of your rates, apart from that big move there. It breaks out. You might get a pullback, but you're going higher. So every major nation, our opinion, is going higher. Probably the least bad is New Zealand, apart from the Swiss, which we've just removed from the equation. But their longer end is not going negative, unlike the short end, which is where all the money is going to hide. It's trying to hide somewhere where it won't die. How about gold? You don't get a negative interest rate. The fact that old Warren Buffett said gold don't pay you no yield, too right. It doesn't pay you a yield, and it won't pay you a negative yield either. So why not have it? It's becoming a feature. It's becoming a benefit, not being paid a yield, because certain instruments that are truly represent some degree of safety, and let me tell you, a Swiss 1 year and a Swiss 2 year product does not represent the same degree of safety that a gold holding does. It still can fail. There still can be events, just not very, very likely at all. But you will not pay a negative yield on gold. It'll still be all there in the morning, as long as you haven't told your shaky mate and your drug addict friends. Otherwise, all odds are off. You haven't told them where the map is. Don't tell them where the map is under the pool. Okay, so that's it on the debt markets, friends. We are seeing all world nations of Western origin typically in disarray for outlook on the yields. Upside is the call. Debt-based collapse is the call. Gold is currently down. You're getting a discount right now for investment. Careful on leverage trading. If you don't know where the stops are, you don't know how to manage money, you must hit the link below. Come and learn what we help everybody see in the form of the HVF method. Then you could maybe take small light leverage opportunities, but right now we don't even have an upside HVF. We're watching it pull back, and it is investment buying time for the XAU USD. Okay, one more thing that I will do with you in this particular video is, because many of you will ask if I don't, this deal is an absolute opportunity to whale into gold. It is the absolute gift. It is an engineered event. So we have the gold silver ratio is one thing everybody wants us to watch. Remember, we said don't write out the possibility that you can go higher on the gold silver ratio. Don't write out in a big enough collapse, a major false flag event or anything else. Well, what do we have here? Actually, technically, at the moment, 100 looks like the magnet, and at the moment, we don't know. You're a little bit higher here. You're a little bit higher than the low there. And you were a high over there. And you're a high over there. This bear flag has potentially broken down. If that was to run its course, that then we may have had a top. We may have. However, one nasty event, and that quickly gets put back into perspective. So if we take that and we put it up top there at the highest point, let's just remove all our scribbles. If that were to transpire, then you have a case for saying that the high for the gold-silver ratio is indeed in on the basis of a flag breakdown. However, if it fails and you rally back up, it's quite clear this 100 level, my apologies, let's draw it in the right place. The 100 level is pretty much a key point of refuge for now. So you might bounce up from here. If we were to bounce up and go again to somewhere like that and come off a little bit, you could start talking about another squeezy Japanesey, which would point to gold being bullish. So there's a bit to see. Are we in the bear flag, making the bear flag target? I think many of you would be in that camp, especially as we made over 100. That's where the bulk of the people are at. I'm like waiting a little longer because there's so much potential bad news and so much debt and so many problems that a major drama is, to me, almost assured. I just don't know what color it looks like, and I'm not sure what they'll geopolitically throw up in the air at the same time to throw up dust and smokescreen at the same time. You could have war with Iran and Pakistan and everybody and its dog, and we could see banking failure, etc. I have to question the fact that we are hearing so little about the state of strength of the banking system worries me, because there should be hedge funds, banks, debt funds, all forms of things related to debt should be in immense trouble. People have to remember that on the HYG trade, and I'm going to leave the gold-silver ratio for a bit, in the event of a big collapse, as I say, I would expect the gold-silver ratio to climb, that HYG was defended by the Fed. I'm going to pull this up. For those of you that were part and parcel of our oil short call and have been following the channel for that long, HYG is in actual fact a ETF of extreme leverage debt, low yield debt. We had the following setup going into 2008, and we called inverted HVF on that and a spiller breakdown, and we got short really high. It was an excellent entry, and it absolutely spilt it down. We thought we were going to be making an absolute mint. It was really deep in profit, and the Fed then came out and said, we will backstop JNK and HYG and the high yield debt market. In other words, the government, the Federal Reserve, it's not really the government, it's a private organization, refused to allow the low quality debt ETFs to fail and said they will backstop it. And that, of course, brought them all the way back up over here. That was Jay Powell, no less. He'd just come in. And then you have the spiller and the rising wedge, which is broken. And you have the dip down and the move back up. Overall, for this asset class, we remain very, very bearish. We remain very, very bearish. Interestingly enough, there's a new draw for this that looks something like this, where that now becomes one big impulse, this whole thing. That is your secondary high, that is your secondary low, and we draw like that. And this is your third high, and that is your third low. So we would funnel this, and we will still bias to the short side. We draw this inside the community and more. This is another short. The only thing we'll do with that is be short. That is where we stand. An ETF on high yield, eventually they will have to surrender, or they will have to walk away, or they will have to default, or something will have to occur, which should see those that are short benefit immensely. So we've done a massive run on the debt markets. We've shown you the gold-silver ratio and said broadly it might be a top, but we put a warning out. If it doesn't let go of that 100 good and properly, you could actually wind up for another event that could see gold become hyper valued relative to silver. That is not bearish silver. We are investors in silver. We love silver, and we want silver to win. And the sooner it happens, the happier we'll be. However, given the amount of pianos that are suspended on the edges of buildings waiting to fall down, you can't help but write off the fact that a major demand-destroying event must be, in many instances, minutes away through a number of bankruptcy-related, bank-related, and every form of interest. And the sudden fear that goes with that could put a big sell on the silver markets. The bankers always utilize those moments to suppress silver one more time, because it keeps a little bit of a leash on gold, because they are tied together, and that stops gold from going a little bit too high, but it normally stretches the bungee cord a little bit more when they do that, because they can bully the little guy down, and that means the mother that's holding its hand, the arm has to stretch and all the slack gets taken out. So watch out for that. Thank you for watching. Don't forget, real opportunity to buy gold. ITM Trading USA, pay the prices I pay. Pure gold, right there. Pay the prices I pay. If you UK and many other nations, if you just want to start and at small amounts, Bullion Vault, grab the link. You can put $50 a day, or a week, a month, and slowly stack. Every ounce you stack puts you in a better position. Real contagion is coming, and you're getting in a dollar cost averaging opportunity as the market comes off right now, which is particularly useful for stacking gold. By the way, lots of banks now talking about 6,000, 9,000. One or two even said 9,000. And others have said 80% up from here. There is a lot of sudden establishment of alibi. You've got to remember, we've been a gold bull channel. I sat down in 2011 and read the gold report out in YouTube's over an old little mic when I was first starting podcasting, why you would look at 5,000. It was from Bullion Vaults, the CEOs of Bullion, and I actually blogged the whole report with all the detail and the charts many, many years ago. Some of those videos that were past a certain duration we put on quiet because we upgraded our audio standards, etc., etc., and they were a bit pasty. It was my early days. I knew nothing about podcasting. I didn't want to become an influencer. I'm trying to warn people about what's coming. Gold has been the great truth that exposes the debt-based lies. Please do it for yourself. You support us by using our links. You pay the same price as we pay. So there's nothing embedded in that. And of course, you can use SimpleFX. You can use crypto to trade gold, oil, and other cryptos. And you can use SCM, where we've actually got a long on platinum. We didn't mention that today. It is set for a bit of catch up running. Let's show you the platinum chart. We'll finish on that. Platinum, platinum, platinum. Bring it up, bring it up. Let's say goodbye to all these debt instruments for you. XPT, USD, we've been warning about this guy for a fair while, it has to be said, and it's been, like silver, a little bit of a languisher, but I would imagine once it gets going big. We've shown this one a few times. That was a massive rejection. I think it's a clear stop placement for you now for getting in on the long side at 969. I think any platinum you buy, sub $1,000, this is 20 times rarer than gold. 20 rarer than gold, which is 8x more rare than silver. This at 969 is probably the bargain basement of them all. You can have jewelry made. It's even more unique and even more special. And that is a long term of manipulation on platinum that has come down. I will remind you that Zelensky, he who probably provided the powder resources for Macron, Starmer, and all these other clowns to try demoralize you with what demented perverts and miscreants they are. He has popped out to South Africa and bought a controlling stake in North Platts. Of course, he didn't know to do that. His handlers, his billionaire friends that control him, the front man, much like elongated muskiness, the front man for the legacy families. These guys are all getting into position for things to come in the future. Platinum to the upside in the future could be an absolute ripper. It's a thin market. If it suddenly starts moving, it would move with extreme pace, even thinner than silver by volume. You've seen this move over here from about 852 to about 2,298. It wouldn't shock me to see this level absolutely smashed at some point, and potentially for platinum to go back to trading at a premium to gold as well. And gold, of course, is at 3,300. That's not going to happen immediately. Many people think it's all just about the industrial aspect. Wait till the bullion demand comes in and starts searching out everything. It could be huge. Anyway, thank you for watching. We'll see you later. Book a call on the link below. We want to help you maximize during debt-based collapse. It's happening, guys. It's a debt-based collapse. You heard it here first, long before Druckenmiller, long before anyone else, the American maxis. And that's not an attack on our American citizens and friends and followers. It's the guys that always say everything wrong with China, everything wrong with everywhere else, not acknowledging that America is the hegemon and is in a debt-based collapse due to the forces that did it to them, not the average American. I don't hold them accountable, but it's going to have a very adverse effect with living standards. And you need to take action to ensure your future. Until next time, we catch you later. Bye-bye for now.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.